again, but we've quickly got to go through this disclaimer. Just as a note, for those of you that attended the webinar last week Friday, I'm going to cover pretty much exactly the same material again. The only thing that will obviously be different is the Q&A afterwards, but you're welcome to stay and listen, but just so that you know, I don't want to waste anyone's time by repeating myself again. Okay, the Auto Charter service includes chart pattern identification in respect of foreign currencies, commodities, equities, and stocks. There are potential risks relating to investing and trading. You must be aware of such risks and familiarize yourself in regard to such risks to seek independent advice relating thereto. You should not trade with money that you cannot afford to lose. The Auto Charter service and its contents should not be construed as a solicitation to invest or trade. You should seek independent advice in this regard. Past performance is not indicative of future performance. No representation is being made that any results discussed within the service and its related media content will be achieved. All opinions, news, research, analysis, prices, or other information is provided as general market commentary and not as investment advice. Auto Charters, MBO Software, their members, shareholders, employees, agents, representatives, and resellers do not warrant the completeness, accuracy, or timeliness of the information supplied, and they shall not be liable for any loss or damages, consequential or otherwise, which may arise from the use or reliance of the Auto Charter service and its content. Hope that was fast enough. Right, so I want to go back to basics. Excuse me. Forgive me for stating the obvious, but when we are making a trade, the ideal for us is to buy when price is low and to sell when it's high. This is it's really the aim of the game. It's what we want. It's what we're looking for. It's very simple. This is how we make money when we're trading. Now, the reason why we don't do it all the time is because we can't always find these opportunities. And the reason why we can't always find these opportunities is because price moves in strange ways. It's a mystery to us where price is going to go next. The closest we can get to it is by making a guess based on what we hear in the news, based on what we hear other people say, following our gut feeling, and also we can use some tools that help us to make better guesses. Now, what I want to propose to you today is that Auto Charters is one such tool. It certainly is our aim to achieve this, to basically be able to increase your chances of ending up with opportunities where you can buy an instrument or a stock or whatever at a certain price, where the price would move sufficiently high enough for you to be satisfied to sell at a profit. Okay, so now I want to explore this process a little bit deeper. What happens when we've made a trade and price is continuing in the direction that we had hoped for? Obviously, we are very happy. We have a good feeling. We feel a rush of joyful emotions come over us, and we want more. We want the price to continue going in this direction. Sometimes we feel this emotion called greed that settles in, and also a hope. We hope that things will keep going our way, and as we know with all the experienced traders, that both of these things, greed and hope, are quite dangerous when we trade. Now, what about the converse? When things don't go our way, we get sad and feel depressed because we made the wrong decision, and we become fearful that we're going to lose all of our money. And the normal emotional responses from fear is to either fight, flee, or freeze, and these emotional responses come from our emotional center of the brain, the old reptilian brain called the amygdala. So in this case, we also have hope that things will stop going against us and turn around and start going our way. So in both of these cases, there's a lot of emotion involved, strong emotions, fear and greed. So I can make a logical deduction that if we're in the market, and in other words, we've made a trade, and unless prices stay exactly the same, which hardly ever happened in the market, then we're bound to feel some serious emotions. We're going to get emotional, and that is going to affect our decisions. And this is where the whole study of market psychology is based on. Market psychology, also known as behavioral economics, is basically looking at why do people make their decisions based on what they feel rather than based on just sound analysis following the numbers. Now what's interesting is that this system, this market, is a feedback system. In other words, when you make a trade, you base your decision on what you see in the market, and that determines whether you think it might go up or it might go down. Yet at the same time, as soon as you make your trade, your little contribution, even though it's minute, once again feeds back into the market, and you've got an effect of what the other people will perceive in the market. So both the trader is affected by the market, and the response of the trader has an effect in the market. Now what does this have to do with discovering good trade opportunities? Oh, excuse me for a second. Just want to in the past, let's say the past century, probably even longer, people's behavior has not really changed by much. And especially in the markets, we see the same kind of cycles and the same patterns appearing again and again. Even though traders learn some lessons, you know, you've got a constant churn of newcomers coming into the market, young, new, inexperienced people that don't always listen to the guys with the grey hair that have already that have already gone around the block a couple of times, that have the experience. So you tend to have the same kind of behavior repeating itself again and again. Now, there's some clever analysts who started studying this behavior, and they've seen that there's a number of particular patterns in price graphs that appear again and again. And they have been able to make some predictions based on these patterns that they discovered in the human behavior. So basically the same outcome of these patterns have been seen again and again. So now if we can forecast what the outcome would be based on the pattern that we've spotted, then actually we have solved the mystery, or to a large degree put together that missing piece of our two-piece puzzle. Remember in the beginning we said let's look at opportunities where we can buy low and sell high, except we don't know where we can, you know, where the price would go high if we buy low. Now with this type of behavioral analysis, we can spot some opportunities that give us a good chance of knowing that we would have a good trade opportunity. So in other words, rather than basing our expectation on just whatever a computer tells us, a black box, pure numerical analysis, you know, that kind of forecasting or prediction, if we base our forecast on the fact that human behavior hasn't changed in the past century, and that it would continue doing, or we would continue doing the same things we do and acting in the same way that we do, then you know that's a pretty much more solid approach or a reason behind believing or finding that our trade opportunities are of a higher quality. So AutoChartist provides the one type of analysis we do is chart patterns. It's a very old theory. It dates back to, I think, the 1930s. It's based on support and resistance, so it looks at patterns that form between two levels, support and resistance levels, trading inside the range, and then breaking out of that range. Fibonacci patterns are based on that golden ratio by the mathematician Fibonacci. Once again, it's also relating to support and resistance, where we discover price moving or turning around at certain points at certain levels, where the levels are in a particular ratio to each other, and then we see there's target levels that where we're expecting to find support or resistance. So this is actually a recurring theme, support and resistance. We find that both with chart patterns. You can see just a typical example here of chart pattern that formed between these two, the gray and the blue line. And then when it breaks out, there's obviously the expectation that it will move to this forecast region. Now what we've done in AutoChart is this: we've taken the sort of consensus view of all the theorists, all the theories, all the analysts that have written about charting. And believe me, there's a lot that has been written on it. You can pick up any book on technical analysis and there'd be a chapter on charting and on support and resistance. So what we've done is we've sort of taken the consensus view, and we've used that and created an algorithm around that to give us this gray prediction area. And recently we've just added this little arrow and a much clearer bottom level of that prediction area that just makes it a little bit more crisp and clear for the user, easier for the user to see what is the expectation. Now, in this expectation, we've also done quite a bit of experimentation ourselves. We've looked at specifically Forex symbols, a group of 20 Forex symbols over the past 10 years, and we found that out of almost 200,000 identified chart patterns, completed chart patterns, our correct forecast rate is very close to 70%, sometimes more, sometimes less, depending on what particular patterns you look at. But as an average, 70% of the time, you can expect that the price, after it's broken through and the pattern has been identified, that it would go to this green line, or if in the case of a bearish pattern, there would be a little red line at the bottom. And quite simply, the reason, what I personally believe, the reason why this rate of accuracy is so high is because of that reason, that the patterns are based on market psychology, and the market psychology is based on human behavior. And we as humans, we haven't changed much in the past century. So it gives us, a solid chance, a really good quality trade opportunity when these patterns are formed. The same with Fibonacci patterns. Like I said before, as soon as the pattern is formed, there's certain levels that we create that creates an expectation for us with support and resistance. Now, with support and resistance being such a sort of strong theme in our analysis, we thought, let's introduce this new type of analysis. Now, this is not available yet. We are in the process of releasing it. You won't see it on your platforms yet, but it will be available from next week onwards. Towards the end of the month, you'll start seeing this and you'll start getting access to it. We'll also make some communication available that your service providers will forward on to you to explain a little bit more about this type of analysis. So what key levels are basically is nothing more than horizontal support and resistance. So a horizontal support level is nothing more than a very important price level. And the reason why we find these levels important is numerous. I mean, there could be the most simple to explain is usually around a whole number. So in other words, when the US dollar, Canadian dollar reached parity, there's usually either a little bit of support or resistance around there, because the number is 1.0 or 1.5 or round numbers like that. People have sort of a psychological expectation for it. the question is it going to go over 1 or not? So whole numbers is important. Then also there are certain levels at which, let's call them structural price levels, where, for example, if an exchange rate would go beyond a certain level, then some maybe some deals that involved large amounts of commodities or assets become viable and become profitable. And then when these deals are sort of mobilized, it requires a whole lot of foreign exchange to make it happen, and that can actually move the price, you know, quite a lot as well. So different reasons why we have important key levels. From our point of view, we don't know, I mean, as a technical analyst, you don't know what the fundamental reasons are behind, you know, particular events in the market, but all you can see is in the price level that there is something there, something is holding the price back. So from that point of view, we identify these levels and we make them available as trade opportunities. There are two types of, let's call them patterns that we see, breakout patterns with key levels. So where the red line would represent a key resistance level. As soon as the price is broken through that level, we would signal that as a breakout signal, and there would also be an expectation with a prediction area or a forecast area a little bit further away. So you expect the momentum of the price that broke through this barrier to take it a little bit further away from that particular level. The other type of level is an approach, when prices bounced against a particular key level, in this case once again a resistance level, again and again, and then it's kind of moved away from that level but turned around and is now approaching that level again. So when the price gets to a sort of like a confidence interval close to that level, then we flag it and say, hang on, the price previously touched that level, it couldn't break through, now it's on its way there again. So the opportunity is that price would probably go all the way to that level again. And then when it gets there, there are two chances. The one is either the price will turn around, bounce off it again, thereby confirming that level again, or it'll break through, and the same applies as we've just said in the breakouts, where momentum carry the price away from the level. Okay, I want to quickly switch to the application, and let's look at a few examples to make it a bit more interesting. I've got my chart patterns window open here on Forex All Intraday. Just to reiterate, the opportunities that we're talking about is that sort of that little bit of potential difference, if I can put it that way, between where the price is currently and where we have a reasonable expectation based on a theory that is based on human psychology that's not going to change very much. And in this case, we can see we've just got a breakout here on Euro Swiss franc on a 15-minute graph, and the expectation is for the price to continue its little bearish trend down to a level of 1.2301. Pattern came through a little bit earlier, a 30-minute pattern on the Euro CAD. Interesting to note there are quite a lot of Euro currency pairs here that form signals. Obviously the Euro is in a lot of turmoil at the moment. I want to look at what goes the other way, Euro, Australian dollar. Okay, so this is a 15-minute pattern that was identified about an hour ago, and now I'm just going to, if you click on this pattern and you zoom in, slightly bigger view, so it's just easier to see. One of the characteristics that we've built into our pattern images is this this horizontal, the vertical dotted line. That just indicates the time at which we